Hello, everyone, and welcome to today's episode of Macro Microscope. This is our third edition. I am Indrani Day, Head of Global Investment Research at FTSE Russell, the index business of London Stock Exchange Group. And I'm joined in today's episode, as always, by John Diofus. He's Director, Data Stream, part of the London Stock Exchange Group. So today's topic, we are going to speak on times of uncertainty. John will be the first speaker, and then he'll hand it over to me. So let me pass on the screen now to John.
Hi, everyone. Yes, Indrani, it is our third episode and quite a timely one. And, everyone says third time is a charm. I say timely because tomorrow is the day that the US Federal Reserve finally cuts rates. And I think it's fair to say the market's been waiting for this for a very long time. I'm going to move into the slides quickly. We'll start off with where we are currently with the CPI data in the US. We're looking at some key constituents of US consumer inflation. And we can see if we look in the last column right on the end, that three of those constituents are still above on a year-on-year basis, still above the Fed's inflation target. But most of them are either at the 2% inflation target or well below it. And if you look at the month-on-month data, which is the second column from the right, you'll see that basically inflation in the US is slowing down, with just housing sort of persistently sticky and potentially causing a slight headache for policymakers in the US. On the next slide, what we're looking at here, we're looking at LSEG's interest rate probabilities model, where we're looking at the Federal Reserve and trying to work out, and basically the model works out where the market is pricing the next move for the US Fed. And what's really, really interesting here, and I think Indrani will speak to this more in her slides, is that a cut, it's a given, right? It's just by how much will they cut. And in the last 4 or 5 days, the most probable action has been a cut of 50 basis points, and the least one by 39% probability as of yesterday's data, the 16th of September, is a 25 basis point cut. Now, this sort of flips the entire story on its head, and I think what's going to happen now is we're going to see it has to do more with growth being a concern for the US than inflation. Indrani, thank you, everyone. Over to you, Indrani.
Thanks, John. So just the disclaimer, FTSE Russell is not an investment advisor, so everything that is said is entirely for educational purposes. So onto the slide leading off from where John left, the growth expectations. Now on the left-hand side, you see the growth that has actually been reported by major economies around the globe through second quarter of 2024. It looks perfectly healthy, right? However, I would argue that this is growth that has already happened and then it's been measured. So it's really in the rear view. And these numbers often go through revisions. It is more important to kind of look where we are right now heading into the future. So for that, on the left-hand side, I'm showing you the ISM numbers. There are 3 series, while the services series is in slightly expansionary territory, seems pretty good. But the manufacturing series, and manufacturing has a higher multiplier effect on the economy, is in contractionary territory. The sub-index of new orders, that's even more quote-unquote predictive. It tends to be, historically, it has been more for, information content in it. That is again in contractionary territory. The manufacturing and the new orders both being in contractionary territory and actually deteriorating in the last 3 months, that's something to take note of. And on the US labor markets, which we know were very strong post-COVID, there are 2 series that I'm showing. These are the charts on the right-hand side. You see the gray line? That's what is called the quit ratio. What percentage of the US employees are quitting their jobs? Employees quit when they have something better lined up. A higher quit ratio is a sign of confidence in labor markets. And see the sharp drop in the quits ratio? It's actually now slightly below pre-COVID levels. And alongside, the headline unemployment number has been gradually creeping up. Still fairly low, But from about early part of 2023, when it was about 3.4, 3.5 percentage points, to today's 4.2, 4.3 percentage points, we are talking almost an 80 basis point increase. So that's again something to keep an eye out. And the yield curve, we are all grown up on the theory that yield curves predict the recession. What I think is even more interesting is recessions historically have happened after a period of after a period of inversion, excuse me, when the yield curve actually disinverts and comes back to a slope of 0. This is the 10 minus 2. And interestingly, as you see this chart going back 35 years, it shows the same point. And the point is, after going through one of the longest and deepest yield curve inversions, we are now at the point when the curve has fully disinverted and is at a flat slope. Again, something to keep an eye out on. And these were things from the business cycle aspect. I would like to also point out we are in the period leading up to the US presidential elections. As the largest economy, the largest equity markets, reserve currency, what happens in the US presidential elections is certainly something to keep an eye out for. And as the curve, these are the average numbers in the implied volatility in the more riskier small cap part of US equities. And these numbers are the averages over the last 3 elections. And typically, what we have seen is this implied volatility increases sharply leading up to the presidential election date and then drops immediately as there is more certainty in the market about who's the winner and what kind of policies could possibly be. So we are in that historically heightened volatility period pre-election. And that ends today's episode on our topic of times of uncertainty. We thank everyone who joined us. Thank you so much.
Thank you.